And the first thing that you need to understand is, what is a spot price? What the heck is spot? How is it determined? What does it mean? And why are there different prices for gold and silver depending on where I go? Well, gold and silver market's not all that different from any other markets. It is a commodity. So when you see a piece of gold, you know, a Canadian maple leaf is a Canadian maple leaf. This one's just the same as the one you can get anywhere else. It just happens that, you know, I bought this one at JM Bullion, for example, and I bought it for things like spot and premium, which we'll get into. That's the first 2 points. Let me tell you how spot's really determined. And this is like the biggest mystery in the precious metals, and it really shouldn't be. And I spent a ton of time talking about this just to educate people. Don't get confused on spot. Premiums are really where you're going to see differences. Spots should be pretty darn close. But since it's such a mystery, I'm going to walk you through exactly how spot is determined, so there is no mistake. By the way, before we get into that, I do have this handy dandy little chart I put up from TradingView. And the gold line, of course, is the gold price. And then the two lines below are the Dow Jones and the S&P 500. These two down here, this is the Dow Jones, this is the S&P. And I graphed them back all the way to 2000. And why did I do that? Because during or since the turn of the century, since we've had the new millennia, gold has outperformed the major stock market indices. And when I show people this chart, it just shocks them. They're like, wait a minute. I thought gold was a barbarous relic. I thought gold was trying to catch up. I didn't think gold maintained value. We had this huge stock run from 2000 to 2022, the largest in American history. And you're telling me gold did better? It's up 270% versus, what is it, 127% for the Dow and about 100% for the S&P. Hey, if you had invested in the Dow and S&P, you made money. They more than doubled. But if you invested in gold, they almost tripled. And silver is a very similar chart to gold. It's not quite as high, but it's pretty close. And silver, when I graph this out, has beaten the major stock market indices as well. I just wanted to point that out. If you're coming into gold and you come from the stock market land and this has been your 401k, you probably did okay since 2000. But you would have done better just simply holding this stuff, the gold and the silver. And that's a point I wanted to make to start off. Why should you even get into gold and silver? Well, here's why. Because it's beat the pants off of the stock market during the best run in the stock market from 2009 to now that we have ever, well, until 2022, before it started selling off, than we've ever had in the stock market history, in the history of the US stock market. And gold still beat it. So even though it's that unloved metal, and silver is this unloved metal, they did better in the stock market. And that's what I wanted to lead off with. But if you want to know what the spot price is, the first thing to do is simply go to jmbullion.com, go to /charts/gold price, or simply look up prices in the search bar. That's how I always do it. I'm lazy. I just do prices here and voila, it gives me the price chart. The cool thing about JM Bullion's price chart is you can do a day, you can do a week, you can do the entire history of gold dating back to, they have it dating back to the early 90s, which is enough. It gives you over 30 years of data. You can do a 1 year, you can do a year to date. So that would be January 1 of the current year to the present date. Or if you want the full year, you can do that too. Or you can specify, you can go down here and say, well, I want specific dates. Tell me between July 1st, 2013 and July 8th, 2017 because of blah. You know, whatever you want to do, you can do that. And you can do it for multiple ones. We've got silver, platinum, palladium. You can compare Bitcoin to the dollar. You can do the gold silver ratio. The gold silver ratio is a good way to know, should I buy gold right now? Should I buy silver right now? Well, if you see the gold silver ratio go down, it means that gold is losing value when compared with silver. Silver is gaining ground. And so it may be a choice of where, well, silver's rising over gold. I may want to get into that rising price environment in silver and buy a little bit more silver. Or you may say, you know what, gold price relative to silver is coming down. That's my entry point into gold. And so this tool can be a way to help you decide how much of each you want in your portfolio. Personally, I just buy them in thirds. I buy a third of the collectibles, a third of the gold bullion, a third of the silver bullion. That's what I've always done. To each his own. You should do what works best for you. Certainly don't mimic what I do. Do what works best for you. In any case, you can basically graph out what the prices are. But the question is, where do the prices come from? How does JM Bullion get this? How do all the bullion dealers get these little prices they put up here? Where in the heck do you get them? Is it all made up? Is it different? Well, you may see slight differences in the prices quoted each of your local and online dealers, only because they're getting information feeds which may be slightly timed to slightly differently, although they're getting it from the same place. And where are they getting it from? Well, the market is run by the CME Group. This is the futures market. And at the end of the day, to use a common corporate phrase, at the end of the day, the gold and silver prices are determined on the futures market. Now, supposedly, It is the interplay and is the conjunction of, or where they meet between the CME Group's market here in the United States that they manage on the COMEX, the Commodities Exchange, COMEX, versus the London OTC market called over the counter. And where those two meet is where the spot price is supposed to go. However, you'll notice on these handy dandy charts, there's something called exchange for physical. And if you look this up at the CME Group's website, this is where people from the US go to exchange a contract in something over to London. And you can see there is a whopping, this is a gold chart. This is a whopping 11,917 contracts went on this day, Tuesday, January 17th, over to London. So if the prices were exactly the same, why would people be playing price arbitrage between the United States and London? You wouldn't have exchange for physical. The reason there is exchange for physical is either somebody wants the physical on COMEX and there's nobody giving delivery of it that month. Maybe there's not enough people willing to say, yeah, we'll deliver the physical. We want to settle in cash. And maybe they have to go over to London for that reason to get exposure to physical gold. Maybe London has a little bit more. But a lot of times this is just price arbitrage. This is what's called an ARB. ARB on the board, which means if you have the commodity, a commodity, trading in one price in one market and a different price in another market, you can run the ARB. You can capitalize on the difference in prices and buy one contract, sell another, and make the difference. And you're just flipping paper. You're not taking delivery. It's just a daily trade. And so a lot of times this is what exchange for physical is. They're playing price arbitrage. But it highlights the fact that the prices aren't the same on London as they are in the US. And by the way, Shanghai in China is starting to gain a lot of ground as an international market. And the gold price is usually almost always higher there. It's a higher physically delivered market. And I believe that they're reflecting the higher physical demand in that market. And that shows you that gold should be priced a little bit higher in the West. But in any case, this is how it's determined. So you get a price here, 1906.10. That's the price as of the close on Tuesday. It's not the price as of now, because if we go back, we're trading, well, we're 1910.81. So it's pretty close. It's within a few bucks. And this does get updated in real time. And that's why you have a difference. You'll be at 1906.10. This is a little bit delayed from what's actually occurring on their system to the point it gets to their web page. And then these guys are pulling it from the system, and there's a little bit of delay. So you might see small differences in spot here and there. So technically, the spot price is the price at any given point in time between the instant settlement. So if you go to COMEX and say, I want gold and silver right now, I'm going to put a contract in and instantly settle, that technically is the spot price. The price I showed you on the screen is technically the futures. It's what people expect it to be in the future. But that futures price, because the COMEX and London are heavily traded paper markets and they are physical. Remember, China settles more physical as a percentage of transactions than does the United States market in COMEX or London. Therefore, the futures really go farther in determining that spot price. I know it gets kind of confusing, but if you just want to know where the spot price is determined, the easiest way is simply go here, and you can see it in real time, and it should be pretty close to what you get at your local coin dealer or the online services like Jam Bullion. And really what I want to know, is gold going to climb the wall of worry? Because there have been a lot of things that have happened in the economy and with the Fed raising rates and geopolitical situations, which cause gold and silver both to do very well this year. Over to technical analysis, because in technical analysis, I want to see, okay, where is it going? Where are the traders going to put their stops? Okay, because all traders, when you're trading on a paper market, a futures market, what you want to do is you want to see where you think everybody else is going to trade to. So for example, if you're trading paper and you know there's a big sell-off coming, you want to get out right before the sell-off so you can, get your money for your paper. You don't want to sell off into the sell-off because it's going to be going down. You're going to be losing money. So traders will graph out where they think the price could be going. And these are the points where they either buy or sell. Pretty simple. Well, we can also use this for technical analysis. Now, remember, technical analysis is always backward looking. We're not looking into the future, but we're looking at in the past, seeing where the price of something had changed, in this case, gold, and trying to figure out why, and then using that as a model for where it possibly could be going forward for some potential projections on our trading, or where we're going to hold our gold and silver at, or where we may buy our gold and silver at. Now, before we go any further, I wanted to mention that this is for educational research purposes only. I'm not your financial advisor and cannot give financial advice, and please do not trade on this information. Okay, with that being said, let's go into technical analysis. Here I have two indicators. I have the 250-day moving average, which we'll get to here in a moment, and then we have Fibonacci lines. Fibonacci is basically Fibonacci lines or sequences is a mathematical sequence that shows up in nature many, many times. It'll be reflected in the markets, and it'll be reflected in other places like population growth and things like that. And it was done by an Italian economist a long time ago who basically figured this relationship out. And then it was eventually named after him, the Fibonacci. There's two different Fibonaccis that I typically use. You've got lines and the arc, and I'll explain those in a moment. For the lines, I basically just wanted to know what the market was doing and why we have this rock bottom price. Why is it this rock bottom price? Because the price tested twice here recently and is now surging past. So I think we're past where gold could bottom to at 1625-ish. I don't think it's going back down. The momentum for what's going on in the market plus the technical indicators indicate that we're not going back down here to the bottom. So I've labeled this the rock bottom price. And if you notice, this is a 50% Fibonacci between the high at the end of 2020 and basically the range traded lows back to 2016. So in other words, this is the base that traders are looking at right here. And this is the peak that they're looking at because this is a new all-time high in gold price, 2069. So going forward, once it reached the peak and started falling, they retired this Fibonacci. They said, okay, this is our price target at the bottom. And this next one could be a price target in the middle. And this next one could be a high. But once we have that event here, which changes the direction of the gold price and the strength of it, you have to do another Fibonacci to see where we're going forward. So why did it stop at the end of 2020? Well, this is the price peak that we had as a result of the pandemic. Once they started opening up and things started recovering, gold price started to fall. People felt there was less risk, right? So this is the run up of the pandemic, basically starting here, or basically starting here at the 50% mark and going pop, and then it started coming back down. So if you want to know now what gold's going to do in the next 2 years, you have to do a new Fibonacci. In this case, I did an arc. So if we look at this arc, all the arc is you draw from a high to a low. Here's the rock bottom price determined by the previous 3 years from 2016 to 29 or to 2020. So about 3.5 years. And then I took the new big event, which set a new all-time high in gold, and I drew a Fibonacci down to the rock bottom price where we know it's not going to go below because it's been above that substantially with momentum. And I'll get into momentum in a moment. So we know that this is our new trading range. So where could the price go next? Well, let's look at this, where the price had traded to in this Fibonacci arc. And just to show you this works, the Fibonacci arc is drawn by the computer, and it gives us the mathematical relationships. You can see we have 100% Fibonacci, a 61.8, a 50, a 38.2. These are the most common Fibonacci numbers in the sequence. It's just determined mathematically to be a predictor of many things, not only markets, but like I said, population growth and other heavy data sets can use Fibonacci's. And so what happened was we dropped the Fibonacci lines, and wherever this arc goes and the price touches it, that is either a support or resistance line. In this case, since the price is falling, each Fibonacci line or Fibonacci intersection along this arc with price is going to be resistance because the market's falling. Risk has been reduced in the eyes of the traders. And so now you're going to look at these Fibonacci lines as resistance lines where it's not going to punch through until we get to the next bull market. Well, look at what we have here. It tested the Fibonacci line right here in July of 2021, bounced off of it, came back down, tested this Fibonacci line right here, came back down, tested this Fibonacci line, came back down, punched back up through this one, couldn't sustain it, came down, touched that one, came down, and then here you have Russia invading Ukraine. Now, this is a big geopolitical change. Now, all of a sudden, we've switched over to a bull market in gold. So we keep our Fibonacci because we're still in this trading range, and we plot out where we think the price could rise. You can see it goes up to this Fibonacci, bounces off, goes up to this Fibonacci, hangs above for a while, and then comes back down, bounces off right here, and comes back down, and now bounces into a momentum indicator. So these Fibonacci sequences told us exactly where gold was going to stop. And the only thing that changed that was a major geopolitical event, Russia invading Ukraine. So when you have a major geopolitical event, it will change the direction of this. Okay, this was, or a health event or an economic event. This is COVID, new high. This is Russia, Ukraine, reversed the fall of gold and put it back into a bull market. That's critical. But it bounces off these Fibonacci's till it hits rock bottom. And then it continues to march up. And what's marching up now, these are all the rate increases that the market is pricing in from the Fed. Here's, rate increase here, rate increases here. So they're now looking at Fed guidance for what to do. Why? You had Russia, Ukraine, but the Fed is tightening, and the Fed eventually wins out overall. You had this nice spike because of Russia, Ukraine. Then the news cycle dies down. The Fed starts raising rates, and you have people recognizing, well, gold's probably going to go up. Okay. So now where could the price go? Well, we know it's not going to go back down through the rock bottom price. Okay, this is the key support line probably for the next few years, I would imagine. It could go below this, but it really would have to have a reason for gold to go down and break a strong resistance line and punch through all these Fibonacci's and momentum indicators. you have to have just a stunning economy. And the economic fundamentals aren't lining up. So I don't think we're going to go and re-challenge the 1625 bottom gold price. What we have done is we punched through this 50-day moving average. You can see 50-day moving average and a 200-day. So real quickly, this is a different indicator than Fibonacci's. Why am I looking at momentum indicators? Because when you switched from the fall in gold to a rise, and these Fibonacci lines switched from resistance to support on the bottom, where it's now going to go back up. When you switch that in the middle of a Fibonacci sequence, you then start looking at momentum indicators to see how strong that move is. Is it going to punch through the next Fibonacci line, the next psychological trader line? One trader is going to say, I don't know if gold's going to go through there. I think in this case, yes, because it passed through the 50-day moving average and the 200. Now, when it goes through both, you've got a breakout in the gold market. If it goes past 50 and 200-day trading averages, so you look at the gold average over 50 days and 200 days, when it does that, that's a huge psychological factor. It means traders are intentionally punching the price of gold up. They see more risk. So this is an indicator we still have risk in the economy heading into 2023. That would be because the Fed's continuing to raise interest rates. The major banks are coming out and saying we're going to have contractions. The OECD, if we go back here, is going to say we're going to have less GDP or GDP, less accelerating GDP. It's still positive and growing, but it's not accelerating, it's decelerating. And what happens when that happens? Gold price rises. Okay, so we're tying those two together. They're looking at what's going on in the economy and they're saying, you know, less output, 2 trillion less of output next year. That's going to hit the markets. It's going to make it harder to finance debt. It's going to raise interest rates in the economy. We're expecting gold to continue to go up. So the next immediate price level is 1846, 1847. And then I've circled in yellow the next Fibonacci. And if it crosses this Fibonacci, if it continues to go, that's the 1900 gold price. Well, why is 1900 significant? Because 1900 is the previous all-time high in 2011, the last time gold climbed the wall of worry. So this gold climbs the wall of worry, could get up to the 1900 level very easily and potentially go through. If the geopolitical and the economic problems are worse than we expect and the Fed continues to tighten, I think we're going to pop through this level and challenge the 2070 level, 2069, I think is what it got to and change. So I think we'll hit 1900 and then we'll see if we pop through the next Fibonacci. If we pop through the next Fibonacci, you know, I'll give you that number when we go through it. I'll come back and we'll regraph the Fibonacci's and tell you where it's going. But essentially, this has been an exact indicator of where the market's going to go at any point in time. And this is what the traders trade to. And the only thing that changes that are big events, big geopolitical events, where the Fed is raising interest rates, or going back here, where you had the Great Recession and the GDP fell. And those are really good macroeconomic and technical indicators to kind of tell you where you're going to go. All right, next, we got a little bit more to the story. The US stock market has fallen off. And so you can see the gold, the exact opposite happens to gold than the stock market. So when you had the pandemic, the stock market fell. I'm just looking at the top 30 equities here in the US, just the big boys, if you will. This is a good indicator of what's happened to the big boys. Why does the big boys matter? Because they're the ones most likely to have available extra credit, the biggest sales, ability to take on more debt, to issue more stock, things like that. And when those guys are in trouble, it's a sign that the rest of the market's probably going to be in trouble. So the big sell-off of the pandemic, slow stair-step down to Russia-Ukraine, that's when gold rose. And so when you have the stock market falling due to these either world health events or geopolitical events, gold rises. So I'm basically using that to determine where we could go. If we have declining GDP and we continue to have, you know, this sell-off in the markets, we'll see what happens in the markets. I think this is going to continue to go up. I think we'll pass 1900 and re-challenge 2069. And then that'll probably come around the end of Q1, maybe Q2, I'm guessing, depending on what the consumer numbers look like for the end of the year. So let's stop sharing for a moment. That's where gold could go based upon the current analysis. Now, what could change? Short of a geopolitical event, short of a major issue in the economy, a bank failure, the Fed making a big change in its policy, a pivot or something, remember, technical analysis is rearward looking and gives us things to try to predict, but these are not set in stone. So if my calls don't go, we're going to examine why. There is a factor why. And remember, technical analysis cannot take into account all the factors that will affect price in the future. Therefore, it's only as good as the information you have in hand. So it gives us a good target and a good model, but doesn't tell us exactly where it's going to land. And that's why you come to Gold Silver Pros. And we're going to continue to analyze that for you. And we're going to tell you during 2023 what's going on. The first place you find that is the weekly market wrap. You can find it on this channel either Sunday night or Monday morning, where we go over the major economic indicators. We give you a really good blowout on what's going on in gold and silver. We tell you the big news stories for the week, and we tell you what you need to do for your trading for the rest of the week, not only in the gold market, but the general markets as well. And that's basically education and research, also not trading information and not a recommendation. I'm not a financial advisor. So that's the first place to go. That's where we'll have their info. And then I'll do these breakout videos about where gold and silver are going throughout the year as we get more information. And I'll use a combination of fundamental and technical analysis to tell you where it's going. All right, that has been it for tonight, guys. Thank you so much for stopping by the program.